Are you investing in AI in 2026? Then you're probably breaking the exact rules that professionals are quietly using to make money. In this video, I'm going to show you 3 simple AI investing rules that pros use but almost never explain clearly. And you need to stick with me, because rule number 2 alone could save your entire portfolio from blowing up. Everywhere you look right now, it's just AI. There are dozens of must-buy AI stocks. Every thumbnail is screaming about the next NVIDIA. And beginners are rushing in driven by pure FOMO. People are thinking, if it has an I in the name, it's going to the moon. But that is not how professionals think at all. They're following a few boring silent rules that protect their money while everyone else is out chasing hype. Let's break down those rules in simple language so you don't become exit liquidity for smarter investors. Rule number 1. AI is still a business, not magic. Just because a company says, we use AI doesn't mean it will make you money as an investor. Behind every AI story, you still need a real, functioning business. Here's a super simple checklist you can use: product, customers, and cash. First, product. What does this company actually sell? Is it software? Are they selling chips? A platform? A real service? If you can't explain in one sentence what they sell, that's a huge red flag. Second, customers. Who is paying them? Are they selling to big companies, to governments, to small businesses, or to consumers like you and me? AI without customers is just a cool demo. It's not a business. Third, cash. Are they generating real revenue? Is that revenue growing? Or are they just burning cash like crazy with no path to profit? Think of a company like Microsoft. Yes, they are huge in AI right now. But the reason the stock is strong isn't magic. It's because businesses pay them every single month for cloud services, for Office, and for their other products. AI is an upgrade to an already strong business. Now compare that to a tiny AI startup that only has a flashy demo and 0 serious customers. Which one is safer for your money? So before buying any AI stock, ask yourself this: if you remove the word AI from this company, would it still be a solid business? If the answer is no, you're not investing, you're speculating. Rule number 2 is position size before prediction. This is the rule that beginners break the most. They find one exciting AI stock on TikTok or YouTube. They feel super confident, and then they dump 50, 60, even 80% of their portfolio into that one single stock. Professionals do the exact opposite. They know that you will be wrong sometimes. Even the top investors in the world are wrong 30 to 40% of the time. So they protect themselves with position sizing. A simple educational rule you can use is this: for risky AI picks, keep any single stock to around 5 to 10% of your total portfolio, not 50%. For example, let's say you have $10,000 to invest. Instead of putting $8,000 into one AI stock because you read sure it's the next NVIDIA, you cap it at maybe $500 to $1,000 for that one position. Now look at the difference. If that AI stock crashes 50% and you put 80% of your money in it, your whole portfolio is down 40%. That's painful, and it's very hard to recover from. But if that same stock crashes 50% and it was only 10% of your portfolio, your total portfolio is down just 5%. That's annoying, but it's very survivable. This isn't personal financial advice. This is education about risk management. The point is simple: your position size should reflect the risk, not your excitement. The goal is not to be right every time. The goal is to stay in the game long enough to let your winners compound. Rule number 3. Time horizon beats timing. Most beginners are obsessed with timing the market. When should I buy? Is this the bottom? Should I sell now? Professionals focus much more on their time horizon. How will this business look in 3 to 5 years? AI stocks are extremely volatile in the short term. In 3 to 5 weeks, prices can jump up and down like a heartbeat monitor. News, earnings reports, rumors, everything moves the price. But when you zoom out to a 3 to 5 year time frame, all that noise starts to smooth out. What really matters is, are revenues growing? Are profits improving? Is their AI giving them a real competitive advantage? Imagine 2 charts in your mind. Chart 1 is a 1-month chart of an AI stock. It's just chaos, up, down. Chart 2 is a 5-year chart of a strong AI business. It has dips, yes, but the overall direction is up and to the right. If you're thinking in weeks, every dip feels like a disaster. If you're thinking in years, dips become opportunities. So if you believe in AI as a long-term trend, which most professionals do, then at 3 to 5 year horizon makes way more sense than trying to predict where the price will be next Friday. Stop checking your AI stocks 10 times a day. Start asking, will this company be bigger, stronger, and more profitable in 2031 than it is today? If the answer is yes, then short-term volatility becomes much less scary. So those are the 3 silent rules professionals follow in 2026. AI is a business, not magic. Position size before prediction. And time horizon beats timing. In tomorrow's short, I'll break down rule number 2 in under 30 seconds, so you never oversize an AI position again. If you found this helpful, subscribe for more simple AI investing lessons, and I'll see you in the next video.